Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at 7 Investing, where it is our mission to empower you to invest in your future. Listeners, as you may recall, earlier this summer, my fellow 7 Investing advisor, Anirban Mahanti, Alex Morris, the creator of the Science of Hitting Research newsletter, and I reviewed 7 former market darlings that had fallen and were down more than 50% from their all-time highs. In that episode, we looked at Block, Netflix, Okta, PayPal, Peloton, Spotify, and Upstart, and judged those companies and whether they were wrecked or they were due for a rebound. Well, I've got good news. The gang is back together, and today, in the second round of Wreck or Rebound, we will be looking at 7 different stocks that are also down significantly from their all-time highs. Like the markets, these companies have begun to climb from the depths of the holes they're in, but we will let you know with a higher degree of confidence than is probably warranted whether these stocks are wrecked and will not regain their all-time highs or will rebound to even higher highs in the future. The companies we'll be reviewing tonight are Airbnb, Cloudflare, Meta Platforms, Comcast, Shopify, Twilio, and Disney. Gentlemen, are you ready for round 2 of Wreck or Rebound?
I'm ready.
All right.
I'm ready.
So,
we called the bottom last time, so this can only go good from here, I'm sure.
It's bound to happen, just like last time. So again, the companies we're going to be reviewing tonight are Airbnb, Comcast, Meta, aka Facebook, Walt Disney, Cloudflare, Shopify, and Twilio. But we're going to begin with Airbnb. Airbnb is now down 41% from its all-time highs. Its market cap, which had once soared to like almost $130 billion, is now down to $78 billion. Alex, is Airbnb a wreck or a rebound?
Well, we should probably start by saying, for people who didn't see it, when CEO Brian Chesky on the day of the IPO went on Bloomberg and was being interviewed, and the woman who was interviewing told him what the opening price was going to be for the stock, the look of shock on his face to think that the stock could possibly open that high was maybe a signal that it was a little bit hot. So it's probably not too surprising that it's had a little bit of a rough stretch here. In terms of the business, though, I think they're really humming, and it's, for me, honestly, it's one of the few names where I look back on the pandemic and think about, the roller coaster ride that the business and the stock have seen. It's one of those businesses where I think they actually really did improve, and their position in terms of the markets that they compete in may actually be advantaged coming out of the pandemic. So this chart shows the number of nights and experience booked over the past year through Airbnb. And as you can see, in Q2 2022, the number was 359 million room nights, which is an all-time high for the business after going through some pretty significant pain throughout the pandemic. As some people may remember, April 2020, the business was down, I believe, 80% year over year. So they saw real pain during the heart of the pandemic. But now we're on the other side, and things are getting back to all-time highs. Next chart. Yeah, this chart just shows the average daily rates for Airbnb. So as you can see from the prior chart, room nights at all-time highs, but they're only up about 10% from where they're at previously. The booking volume through the platform, the dollar booking volume or value, is a significantly higher number, largely due to this chart, which shows the average daily rates. You've seen a significant increase, largely due to price appreciation, simply how much people are listing their homes for, and then things like mix shift with markets like North America and the U.S. specifically coming back quicker than places like APAC, which was a lot of cross-border travel and is still recovering. So this has been a pretty significant tailwind for Airbnb's business because it's a take rate business. They just take a cut of basically the booking value. So it's been a very nice tailwind. Next chart, please. Yeah, this is one of the reasons why I think this business is more solidified and in a stronger competitive position going forward than they might have been pre-pandemic. What this shows is the percentage of long-term stays on the platform, which they define as anything 7 days or longer. And as you can see, it was right around 50% of the business in the earlier days of the pandemic. Even today, 45% of stays were for 7 days or longer, and 19% were for 28 days or longer. And for me, this is just really important because as I think about the consumer value proposition, you think about 1, 2, 3 night stays, you really do compete with hotels for that type of trip. But when you get to 7, 10 or month-long stays, it's kind of a different experience. And most people, or at least I would definitely argue, that Airbnb has a bit of a consumer value differentiation and a competitive advantage in some of these markets where they compete with, much smaller players like VRBO. Next chart. Yeah, and this really brings together how the business from a financial perspective has really improved coming out of the pandemic. The company got some real religion on things like cost efficiency. They were able to test things like performance marketing. How much money do they actually need to spend to drive volumes on the platform? And what they learned as a result of the pandemic was that they could rely on their brand a lot more than they may have assumed previously. So as you can see here, since pre-pandemic, adjusted EBIT margins have improved by 2,900 basis points. So just a complete change in terms of the financial profile here, which is part of the reason why I believe this company is very well positioned for the future.
So, Alex, I gotta say, so as like traveling with a family, the value of staying at an Airbnb or Vrbo is it's so much better. It's such a much better experience than staying in a hotel, like where you're all crammed into one room on 2 beds. Like, me, I have a family of 6. So we're either getting 2 hotel rooms, which is definitely going to cost more than getting an Airbnb, or we're going to get one of those, it's not I'm not getting a deluxe suite, but I can get like a room with 2 beds and a pull-out couch or something like that, and everybody's cramped in. Everybody's kind of miserable when you're going to bed. It's such a miserable experience. That being said, so I love staying at Airbnbs and Vrbos. That being said, you still hear like these horror stories that kind of go viral, or at least semi-viral on social media. And people, you have other people say like, I'll never stay at an Airbnb. It's only hotels for me, with a uniform experience, what to get. Like, do you think that's like a long-term, is that worrisome at all? Like long-term?
Yeah, I think it is. I always make the comparison of, if you look on Yelp and something has a good review and it's actually not a good experience, you can deal with that because it's a bad meal. You book a 7-night stay somewhere and it's not what you thought you were going to get. That is a very bad thing for a brand if that's what you're going to experience. So Airbnb for a long time has had host guarantees because it was very important for getting people to be willing to list their homes on the platform. I think you see them more and more focusing their efforts on kind of consumer guarantees in terms of, if you make a booking, it's going to be what you got or what you thought you booked. And if not, we'll do everything we can to ensure that you get basically something of comparable quality or value. So I think it's a big part of what they'll lean into going forward. And the other part of this, which speaks to the kind of start of your comments, is Airbnb is in such a unique position given both the size, but also, the single source for a lot of their supply. They just have so many listings that are not on other platforms like VRBO. And we've really seen coming out of the pandemic, their ability to play this game of attracting supply and attracting demand and how those two components play off one of each other. And features like I'm Flexible and categories, some of the kind of product enhancements they've announced as of late really play into that value proposition and the growth of both sides of the platform. So they really have the flywheel spinning right now. And I think this management team deserves a lot of credit for where the business is today.
And I just have a quick comment.
Yeah,
just a quick comment. Just that we went on a longish trip to the UK and or England and Scotland, and I only used actually Airbnb only once at Scotland, and the other places I actually landed up booking similar accommodation using Expedia or Booking.com because they've also started basically featuring similar types. One thing though, what I noticed is that if you are looking for like the perfect like experience styled accommodation, something unique, something in, some location that another person is not going to think about, then I think Airbnb does have a significant edge because a lot of those properties are listed exclusively on Airbnb. But when you're looking about city or city style, like country club or, golf club type of accommodation, those are actually now listed across multiple platforms. So do you think competitive pressures with platforms like Booking, which also have hotels, and Expedia, for example, is an issue? Probably not given those EBIT margins, but.
Yeah, I think this is It's funny. I in my first write up on the company, I kind of made some comment about how the S1 had certain disclosure around KPIs like the number of hosts and the number of active listings and some other metrics that you could use to back into how many people are single hosts as opposed with one home. And they also would disclose how many are exclusive to their platform versus a professional host that can and will list everywhere. And they've been more reticent to give that data out, at least consistently. And for me, it's one of the most important KPIs, if not the most important KPI, to know that when you go on Airbnb, it's going to have supply that's unique and that will not be found on other platforms. So if they live up to the needs of their host, especially the person who's listing it and making $5,000-$10,000 a year, it's not a full-time job, it's the side gig. That is what gives this business a sustainable competitive advantage. So they have to meet that need of their hosts. And I honestly think it speaks to, as I wrote about here recently, it speaks to some of the design decisions that they're making with the platform. So for example, if you go on Airbnb today, you can't sort your listing by the number of reviews or the quality of the review, the star rating. And I think they've done this for a very purposeful reason, even though it somewhat hinders the guest experience, in my opinion. And I think the reason why they're doing it is because they're trying to grow that long tail of supply. They don't want to hinder someone who is just listing a home for the first time from getting that first booking. So they've made a product design decision that this is worthwhile to do. And like anything in business, it's a risk, and we'll see how it pays off for them.
All right. So next up will be Cloudflare, Anirban. Cloudflare is 66%, 2/3 off its 1 year all-time high. Its market cap is now let's call it $25 billion. At one time, it was close to $70 billion. Anirban, is Cloudflare a wreck or a rebound?
Well, with the full benefit of hindsight, I mean, at like $70 billion, there was a lot priced into the business. And, while the business has actually continued to grow through the pandemic, it's been a very consistent grower, delivering that 50% plus revenue growth consistently through. It hasn't been impacted by the pandemic. The scale of the business as the business revenue base has grown hasn't been impacted. But one could just say that, it was just significantly, I guess, overpriced based on that, that 60, 70 billion or 70 billion market cap, right? At that point, market has basically, seen an interest rate increase, which basically means the future profits have, when you discount them, you're discounting them with a higher weight. And that's probably impacted its valuation. In terms of is it a rebound? Yes. I mean, the way I look at these charts is, I ask my question, it's not whether or not it's going to go back to the previous highs or exceed that. The question I ask is, can it be a market beater from here on? And I do think that, Cloudflare can be a market beater and a significant market beater. It's a very innovative company. Give me my next slide. Yeah, so so one of the things with most of these software companies is if you look at their operating profit line, then this chart is actually from the Q1 2022, not the Q2 2022. I didn't want to make another chart, so apologies for being a bit lazy, but you could make something similar for the current. You notice that this had an operating profit of 2%. 2% operating profit on a business that's approaching $1 billion revenue run rate. It seems really tiny and suggests that, are you going to ever make money? But the way I like to think about this is, look at the cost for goods. It's, so it's a high margin business. It's 78% gross margin. So general and administrative expenses is about 15%. R&D is 19%. And the way I like to look at this is I look at the sales and marketing line and say, well, it's about 42%. Then most of these software businesses are land and expand. So they land a customer and then are able to sell more and more to the same customer base, right? So if you assume the sales and marketing roughly, and this is an assumption, that you're spending roughly, say, 21%, half and half for landing and half for expanding, then remember the landing does not give you profits or does not give you revenue right now. The revenue and the profits from, is going to come in due course. So if you just remove the landing component, so you assume that you cut the sales and marketing piece in half, right? You could still get the expansion that's happening from the existing base. And, this company has been able to expand its revenue about, 25, 26% over last year just from the existing customer base. That's dollar-based net retention. So if you think about it, another way to think about these businesses is that these businesses can organically grow revenue at, say, 20, 25% and have an operating margin around 24, 25%. That's pretty healthy, right? So the reason they're trying to expand land is that they can continue having a larger and larger piece of the total, greenfield opportunity. So that's the way I like to think about software businesses. That inherently, these can be really, really profitable, and you can see that this is really, really profitable. So I think now it's a good time to actually own Cloudflare. I've owned it through the highs, and if the business continues executing on its promise of making the internet better, it's going to be a much larger business than it is today, right? And yeah, and thanks for actually putting this chart out. This is another way of looking at the valuation. What I like to look here is this is just trailing sales, and on the denominator, so not trading sales, trailing gross profit on the denominator. And the reason I have this is some businesses have a higher gross margin, some businesses have a lower gross margin. And on the numerator, we have the enterprise value. So you can just see, look at the black line, which is for Cloudflare. It was 150 times gross profit. Maybe there was time for me to should have taken some profits off. But it's just, these are things which are good to do in hindsight. At that time it's but this business can still double in 5 years. Should I take some money off and then pay taxes, or should I just hold on, right? But you can just see how it was, and now the valuation has come back sort of to where it was when it IPO'd, around that base level. There's another company we're going to talk about, Twilio, but you can see that this one's multiple has actually completely compressed. So where, on a trailing basis, then the enterprise value for gross profit for Cloudflare sits at about 38, 39. It's actually bounced off from the lows because it had a good quarter. The second quarter was actually pretty solid. Twilio is sitting at 7, which I think is downright cheap. But, so I think, Cloudflare is an excellent company with an excellent CEO, doing really well.
So, and Anirban, right? So, I'm not an expert on Cloudflare, but it's like this global network, and it makes your internet faster, more secure, more reliable. But they live at the edge of the internet, right? And they're not at the, I don't know if I'm explaining this right, but they're not at the, the center cloud infrastructure like AWS or Azure. They're more on the edge towards the user. Does that, yeah. So my question about Cloudflare, and it was the same question with Fastly, that race to build their, I don't know what you want to call it, but their centers, their network hubs, out to the edge of the internet. Does that ever end? I just if they just do they have to keep getting closer and closer and closer to the end user as more bandwidth of the internet is used up? Can they ever stop spending and I guess really scale this thing?
Yeah, so the number one thing is, unlike the hyperscalers, right? So their capex is actually pretty low. If you are Google or if you're Amazon, you're spending a heap of money on capex and building these huge data centers and farms and things like that. This doesn't happen for a company like Cloudflare, largely because they co-locate things with telcos. So really, the telco, your Comcast or AT&T or whoever, those guys are the last mile, right? So if you can co-locate your equipment with them, then you save a lot on the cost, right? They're already pretty much everywhere. It's a question of how, and they use commodity hardware. It's a question of how they expand the software along with the hardware to run on the hardware to make it a better platform. So till date, they've been just doing things like DNS and application performance and bot prevention and denial of service attack prevention, things like that. But if you want to actually turn it into a platform for store and compute, which is basically them trying to compete to some extent with things like Amazon Web Services and Azure and so on, then there's a different type of CapEx involved and there's a different type of software development involved. So that's what they're trying to do. And the CapEx might grow. But to answer your question, I think if you think about just performance, then being closer or being in the last mile helps you with performance because it reduces latency. You can't reduce the latency because that's the lowest you can get. That's the last mile, right? So being in the center doesn't help you. Being more centralized doesn't help you because you're not close to the last, you have to still get to the last mile. Then only do you get to the user. So if you can be close to a user that you can be more, performance oriented. So this is important for certain applications. So they're not very expensive in terms of capex right now, but they're also not really doing a lot in that storage compute yet. So the question remains in my mind is what is going to happen in that storage compute? Everything else that they're doing, like zero trust and being a reverse proxy and then doing the denial of service attack prevention. Those things are actually not that expensive in terms of, I guess, capex.
I have a question on the, just thinking about reflexivity and obviously stock prices being down a lot. We're hearing about, in tech sector generally, firings and things like that. And the margin profile chart you showed really laid out clearly, it's not really representative probably of what the underlying profitability of the business is or could be. Have you seen management's kind of commentary around those type of things change? Are they more concerned with showing short-term profitability, or is it listen, our strategy is working, we're staying focused on the long term, et cetera?
They've been pretty. They seem to follow. They like to follow the Amazon way of, we're not going to show you a profit as long as we can find a higher return on investment opportunity inside the business. So therefore, they're pretty clear that they're going to run around at break even. And in terms of like deals and so on, they haven't said anything in terms of slowdown. Although almost every software company has also hinted at, the macro is dead, and some people are concerned. Some industries are more concerned than others. But we haven't seen anything yet, but we want to be conservative. That's been the general language. And then in some cases, the deals have elongated. It's taking a little bit longer to get those deals done. Nothing in terms of the macro, and nothing really in terms of they seem to be pretty consistent in the messaging that they have telegraphed to the market. So,
and Anirban, how big do you think Cloudflare can be one day? Like, what are we talking in market cap? Because I've seen some people say like one day there's a future where it might be like even bigger than like AWS.
So that is the bull case, right? The bull case is that it replaces a lot of the stuff that happens. So I think one of the things that a number of things we need to keep in mind, right? So if you think about, I use a different example. So if you think about, for example, Amazon, right? Web services is growing at 35% at that scale. And, something like GCP or Google Cloud Computing, which is significantly smaller, still continues throwing dollars at it because they know that it is very early days, right? At the same time, these guys are basically saying, well, we don't have to disrupt that, but we can disrupt the model of computing by saying that, well, you do a lot of those computations that need to happen closer to the user at our data centers, so to speak, or our POPs, points of presence, versus doing that, in the centralized cloud. And you still do use the centralized cloud for very data heavy things, but you move some of the compute to these guys, right? So if you think about it, the industry is still in very early stages of evolution. There's going to be a lot more evolution possible. Yeah, and it could be, something like an AWS in say 10 years, right? Can it get there? And it straddles a number of industries, right? So it's trying to get into storage and compute. It's in security or cybersecurity. It's in network provisioning, right? So they do own pipes as well of their own so they own some network pipes as well, or lease network pipes. And so they have a dedicated network of their own. So they do a lot of stuff that, encompasses things from a little bit of what Cisco would do, a little bit of what, Zscaler and, CrowdStrike and Palo Alto Network would do, and a little bit of what Amazon is doing. So it spans a lot of different things. You could say that is their focus or not, could be a question. But yeah, I mean, if you execute to it, there's a lot of room here for growth.
Excellent. All right. So next up is Meta Platforms, formerly known as Facebook. This company, this stock is down 55% from a year ago. Its market cap, it was over $1 trillion. It was close to 1.1, $1.2 trillion. It is now under $500 million, just down to like $470 billion. And where to begin with this company that I've owned for going on about 8 years now? Where to begin? So many problems, but let's start with let's start with how much money they're spending, right? So like this is just like their capital expenditures, just over the last year, how much they've grown from the second quarter in 2021 to the second quarter of this year. It was up to $7.7 billion, year to date now, on CapEx, just CapEx, they've spent $13.2 billion. Meanwhile, their headcount is exploding. So like, can this cycle ever end? And, I guess where I'd start is saying like, Zuckerberg on the last call was saying like, he was kind of walking back the ramp up in CapEx. Like a quick quote from the conference call. Zuckerberg goes, "I discussed that based on the revenue growth we were seeing in 2021, we kicked off a number of multi-year projects to accelerate our business. And I still believe these projects are important, but given the more recent revenue trajectory that we're seeing, we are slowing the pace of these investments and pushing some expenses that would have come the next year or two off to a somewhat longer timeline." Now, the one thing I'll say is Zuckerberg has a very long-term vision. Like he doesn't care about like a particular quarter's results. And sometimes I find that frustrating, but overall, that's actually what I really like about Zuckerberg. He has a vision and he's running to like where he thinks the puck is going to be in 5 years, in 10 years, not where the puck is now. He says they're going to be steadily reducing the headcount over the next year. And he goes, "I expect us to get more done with fewer resources." So let's hope he's right and sticks to that. So like the monthly active people on Facebook has not, and this is their family of apps, right? So we're including Facebook, Instagram, WhatsApp, Messenger, has now grown to $3.65 billion, 3.65 billion users. And so like, you minus China from the world. And I mean, we have basically saturated our markets. We're not going to see much growth here. What I find incredibly encouraging is like, this has not decreased. And I think that's almost remarkable with how many negative headlines they face and with how everything else that they're going through. Like this number has not come down. So right now, and some of the things that I like about this is that we're seeing engagement. Like there's a lot of encouraging signs with engagement. And I think one of those reasons, and this is kind of controversial with what they're doing, but I actually like it. Right now, about 15% of a content and a person's Facebook feed, and more than that in an Instagram feed is recommended by like Facebook's AI, and not based on just their social network. And Reels is a big reason why. Reels makes up now more than 25% of the time users spend on Instagram, and it's reached a $1 billion annual revenue run rate. That's to me is pretty impressive. I will say this personally. I don't have TikTok on my phone, and I only had an Instagram account to monitor my son's account, and my daughter got an account. So I just got on to monitor them. And now I go through Reels like I do, and it sucks you in, and it's like, I can see why, people engage with it. There's a lot of problems with Facebook, and we can like the macro economy, the supply chain crunch, which is like hurting e-commerce. Meanwhile, you have e-commerce normalizing from the rates it saw during the pandemic. Meta is under the microscope of regulatory agencies. Like, they wanted to buy like a simple little VR meditation app, and the FTC comes in and blocks it. Meanwhile, Microsoft is buying like $70 billion acquisition of Activision, and that looks like it's going to go through. Facebook has to, they have to monetize their content. This is important because like the feed is like just extremely profitable for them, and it's more profitable. It's easier to monetize the feed than stories, and it's easier to monetize stories than Reels. So the way content is evolving and going, it's getting harder and harder for Facebook to monetize that. And of course, last but not least, we have Apple's iOS changes. So it has all these headwinds it has to go through. The only thing I can say, like, if engagement stay steady, if users stay steady, I think Zuckerberg's going to figure it out. I mean, they have a lot of optionality with this business. You have WhatsApp payments that, I think it's going to take off in India. You have social commerce, and I don't know what's going to happen with the metaverse. I have no idea. It could be a big flop. That being said, I still think they have a lot of optionality. They're building out their AI, and as long as users and engagement stay steady, I think they're going to be basically okay and recover from this. I know both of you guys have strong opinions on this, so I'm just going to turn it over to you guys.
I'll start with a question for you, and it's a question I have myself. And a big part of the Q1 call was this idea of we're going to take a balanced approach. Obviously, we're starting from a somewhat unbalanced place with $10 billion in losses, but that's in FRL. But that's kind of the starting point, and we're going to have this trade-off between FRL losses and FOA growth, such that overall operating profits for the company grow. Well, we've very shortly seen how in a tough macro environment, FOA it's not by decree that they have to grow, and FOA is under a bit of pressure. Do you think if this sustains itself for even another 3 months, 6 months in terms of tough macro, do you think we'll see meaningful change in terms of how they think about the FRL spend, or do you think they'll say, listen, we meant this in terms of a multi-year horizon. We're not going to change our plans just for the sake of living up to that kind of framework?
All right. So two things I'll say, and I don't know if they're like crutches or if they're legitimate. So you push back on me, but like what I would say is like one, like I do think Zuckerberg has a long-term vision. Like say what you want about Zuckerberg, but like like the greats, who I consider the greats, right? Like you can go to Bezos or, a number of Bill Gates, Steve Jobs, like they have long-term visions, right? So they're going to see through like these, what you could call temporary headwinds. So for a lot of those, I went through that laundry list of like headwinds Facebook is facing. I think a lot of them are temporary. Some of them are longer lasting and more worrisome for sure though. But like a lot of them are temporary, and like Zuckerberg's going to see through that. Now, I think like he'll see the data more, and what he determines is from iOS, which might be longer term. What he sees like from competition like TikTok, which could be longer term. What he sees is like just this, I mean, I'm not trying to get political, but just like very intense scrutiny from regulatory agencies, more than seemingly other big tech companies face. Those things are, to me, are more worrisome and longer term. And I'm sure he knows it. So how much you determine these headwinds are from like the shorter term problems to the longer term, I think will dictate that. But I think Zuckerberg's not going to worry about 3 to 6 months slowdown, e-commerce normalizing from the pandemic, a recession, things like that. The other thing too, I'll say is like, I think it's like steering a ship, right? So that like the spending like is determined before the quarter begins, right? And then the quarter goes how it goes. So the spending, like even if they're trying to like roughly match it to the profits that the family of apps generates, it's still going to like, there's going to be a lagging factor. That's just going to be like, inherent to that strategy. And so that's how I, so one, like this was the first quarter, right? After they said it, and it was like an eventful quarter. So I would say like we, as investors or shareholders, I'm going to be more patient with that because I think there's just a natural lagging factor to it. And two, again, I think Zuckerberg, I'm hoping anyways, and I think he will like discount the short-term headwinds completely and take into much more account what could be longer-term headwinds.
A point I probably should have added there in the question, which I think is relevant to the extent we're saying this is kind of the macro-driven part of that short-term headwind. This company remains in a financial position that is, I mean, pristine. even with the business facing pressure in terms of year-over-year results, balance sheet, cash flow statements still look fair. Even with the massive capex growth, there's still very significant free cash generation here. They have, I mean, especially when you can't do M&A, they have all the capital that they could possibly need. And
100%.
But it'll just be interesting to watch that in terms of how much pain they're willing to take in terms of market perception, which is, I mean, it's a real thing. I think it's partly what led to what was said on the Q1 call and the Q2 call, to your point.
Right. And finally, and then Anirban, I'll turn it over to you. But and finally, and we haven't talked about this, but the valuation's not too demanding right here, right? So so to me, I do think it's going to rebound. Now, of course, the trailing PE ratio, whatever you want to go by, it looks a lot better than what the forward PE ratio looks like because earnings are being cut, and that's going to happen for a few more quarters. So I get that. I'm just saying, the starting point of its valuation is not too demanding. It's in the position where it is able to invest in the future. This isn't an unprofitable company by any means. Its balance sheet is pristine. They have had missteps, and Anirban, I'm sure you'll bring up their buybacks, that were ill-timed, let's say. But longer term, I think, Alex, you and I both think this is going to be a rebound. Anirban, though, what are your thoughts?
I think I agree with some of them. I think that the valuation is undemanding if you assume that it can get back on its feet. To me, this I like to call this the sort of the Yahoo of this generation, and the reason I call it that is I think it's a terrible place to be a big business with no ownership of platform. It owns platforms that run on other people's platforms. And that means you're always susceptible to the changes, right? And changes, you're susceptible to what's happening in the underlying space. And part of that, so that just makes growing harder. You bought back buybacks. So I think, for all the people that you mentioned, right? I mean, Zuckerberg's capital allocation skills of whoever was doing capital allocation for him really is bad because they bought a lot more shares at their peak. Now, I think I know what was happening. So they were basically their buybacks sort of looked like, to me at least, looks like a function of free cash flow. And as the free cash flow basically dwindled, they had to, step down their buybacks, which sort of doesn't give me the confidence to say that, if you really believe in your business, this is the time you should be lapping and buying. But they're doing buybacks proportional to their free cash flow. So that bothers me. I think it's insanely mad. No, okay, I'll rephrase that. I think their spending on metaverse is at a maddening level. As Tony Fadell, one of the co-creators of iPhone and iPad, basically said, the amount of money they're spending in one quarter, Apple did not spend that much to produce both the iPhone and the iPod. So sometimes, actually, I think what I think at a fundamental level, I call Google and Facebook as companies that are engineering focused. From being an engineering company to becoming a design company to producing something that is going to be used by a lot of consumers, consumer facing, it's extremely hard. It's not that you can't hire people, but you just don't have the DNA in your company to actually do that. That results in all this spending that is just flagrant spending of money. Money doesn't buy that. Is my argument. The final thing I'll say on metaverse and everything else that they're trying to do is, they seem to be laser focused on Apple, that they want trying to compete with Apple, but they forget that Apple is going to produce the first version of the product that's going to have mass acceptance, and then Google is very quickly going to copy it. Where is it going to leave them in that space, right? Because you can't assume that Alphabet is just going to let Apple have the metaverse space or VR, AR space to itself. It's not going to be like that, right? It's been a duopoly, and a fast follower is always is very quick to follow through. So I think the final thing that I worry about with this company is, as sort of the consumption patterns and as the usage patterns of social media changes, there's nothing that says, TikTok basically came from nowhere, right? There's nothing that says that something else doesn't come from anywhere and, usurps the position that is occupied by Facebook and, Instagram and so on, right? And I think switching, actually, this I think is a fundamental mistake in my opinion. But again, I don't know much. I'm sure Zuckerberg is, of course, smarter than me. But the fundamental mistake, I think, is going from a social aspect to a completely AI-driven, feed-driven approach basically takes away that social element, right? So one of the reasons for having strong network effects is negated by using an AI to just feed in out, feed in stuff that is current today, trendy today, may not be trendy tomorrow, which means you're depending a lot more on the algorithm doing a lot of the heavy lifting for people peeping around. So I don't know. I think that there's some strong headwinds there for this company. I would say that the right strategy, in my opinion, would be to actually cut back a lot on the spending. They don't need to do that kind of capex and R&D spending. They can just halve that. And if they did that and focused their R&D efforts and actually bought back stock, I think that would make me actually a lot more bullish. Then, right now it seems like a lot of arrows and darts trying to find the bullseye. Instead, you just need to pick a few things and then hope that one of them is going to deliver. But anyways, that's my position.
Yeah, there's a lot there. I have one comment that comes to mind for me, and it's as I think about FRL. A lot of this, from what I've seen and what I've followed with this company, a lot of it has been kind of the underlying technology, and a lot of it has really been on the hardware side, it seems. And now we're getting to the Horizon Worlds launch and an ability to see whether or not this company can generate any traction for, something that could, at least in theory, be, a Roblox type of experience, at least. And obviously Roblox isn't a hardware company. They're just purely the platform. And I'll be curious to see, one, how the adoption goes, and two, how they respond to that outcome. It'll be an interesting test to your point, and a point that I think Matt and I both probably agree with. At some point, the numbers have to be justified, and what are we spending for, and how long does it take to get there? A hard part for this has always been if we're talking 5-10 years down the road and you're starting at 10 and the numbers going higher and higher and higher, that can be dangerous, especially if you have questions about the core business. So this is an early test in my mind to see how they respond, especially if they get an adverse outcome, how they respond, and what that says about their ability to balance the vision here with the realities of what they're seeing.
I think I agree with that.
I think that is, I guess, one of my biggest concerns. There's many, but like one of my biggest concerns is like Facebook is like, or Zuckerberg is just so determined to like make this happen. Like he would be willing to go down with the ship, like what there was like a quote several months ago, like, in a publication that was like, Zuckerberg sees this as his iPhone moment, or something like that and if the metaverse, he sees the metaverse as his iPhone moment for, and if that's the case, like that almost scares me, like if he's willing to just like keep pouring money into this after it's shown, if it can't gain traction and things like that's what would really scare me. The only other thing I'll end with this, like I think that recommending like reels with AI and like user social graph is like better than just AI, and Facebook has that. And like I think that's because nobody I know that on Instagram makes reels, right? I mean, so it's nothing, none of those reels would come up if it's just my social graph. So they almost have to use AI, and it's very effective. Like I see now why like TikTok is so catchy, and it's like that brain candy, right? But having that social graph, like, oh, I send the cute animal videos to my daughter, I send the Star Wars parody videos to my son, I send like whatever videos to my wife, like having that social graph input on top of its AI that its AI can use, I think is just like powerful and like an advantage TikTok doesn't have. And like, yes, TikTok came out of nowhere, and another thing could come up out of nowhere either. But like, as we saw, like the users haven't gone down at Facebook, and engagement trends look good. So I'm not worried too much about competitors coming in and just usurping Facebook.
I think I just add on that point real quick too, because I think it's incredibly important. This idea of demographics and who the users actually are, and this conversation in my mind is frequently framed in terms of very simplistically US teenager type of view, which is relevant, but it kind of misses the broader point. As Matt put so well, the user base, even in the US, even just for Facebook and Messenger, not even the family, it's at or near all-time highs. So it's funny, as you said, you've owned this stock for a very long time. I've owned it for I think 4 years now, the concerns around the user base and engagement have been prevalent since before I bought the stock. And, at least up until this point, some of the data leads you to believe that conclusion is at least partly incorrect. But obviously that is not black or white. There's no question that they've lost some mind share to TikTok and other internet properties, in my opinion.
All right. So we should probably move on. So our next stock that we're going to look at is Comcast. Comcast is down, not as much as some of our other stocks we've looked at, but it's still down 38%. And that's a lot for what I think should be like a stable, kind of recurring revenue business model. Its market cap is now $170 billion. At one time it was over $280 billion. So Alex, is Comcast a record rebound?
Sure. Well, let's just jump right into the first chart because I could probably frame this discussion in the appropriate way. This shows the trailing 24-month internet customers, basically, for Comcast and the other large player in the U.S. market, Charter. And as you can see, coming into the pandemic, they were both adding, let's call it 2.5 to 3 million net subscribers every 2 years. During the pandemic, they saw a major tailwind. That number jumped up by about 1 million subscribers. Now you can see today, Comcast for the trailing 24 months is kind of back to where they were pre-pandemic, maybe a little bit higher, and Charter's a little bit lower. But so I think there's a part of this story that is a pandemic tailwind and then hangover on the back end, which is always isn't a easy thing to kind of quantify in a single quarter or a single year. But on top of that, what we're seeing now, and this chart, the numbers on the tail end are much worse than in some of the earlier periods that are captured. The growth rates have effectively gone to zero, and management points to a couple things, one of which is a meaningful decline in mover churn and new household formation, which is, obviously these are ways that they add new customers, as management for both companies likes to say. They win more of those jump balls than they lose, so it's a way for them to take incremental share and add customers. So when people stop moving or stop building new homes, that is a major headwind for their business. The other notable development that's happened is fixed wireless competition and fiber as well. But fiber has been around for a while, and it's been, I would say, a fairly manageable and more of a steady competitive factor. Fixed wireless is more of a newer development, particularly in terms of T-Mobile's recent success in the space. And I think it's tough to frame. I wrote an article about this recently. It's tough to totally frame what that looks like a few years down the road. I think, as one of the charts coming up will show, there's going to be questions about the capacity of their network to handle a big influx of internet users, as well as the attractiveness of that customer relative to a wireless customer. So T-Mobile, if they're capacity constrained, will have to make basically a choice between the two. And the wireless customer is a much more preferential customer. So they're going to have some decisions to make there, but the point still remains that if a new competitor enters the space, that is a headwind to growth stats. Next slide. So partly what's happening here is Comcast and Charter, through their MVNO agreement with Verizon, have basically moved into the wireless business. And they've had decent success today with both exceeding 4 million lines now. And this is really where the industry is kind of going, in my opinion. It's a convergence between kind of the wired and the wireless networks. And if someone like T-Mobile can be successful with fixed wireless, which is a home internet product, the question, I guess, becomes who will win in the fight towards convergence, or is there another development that gets the industry to a kind of cleaner structure? So it's obviously going to be very important to watch, but Comcast and Charter are going full steam ahead on their wireless businesses. Next slide. Yeah, this just shows what I said before, basically a huge discrepancy between a mobile user and a kind of fixed internet customer user in terms of data consumption. And if you're T-Mobile running things on the same network effectively, it's much more, it uses up a lot more of your capacity. Next slide. Yeah, this final chart just shows the trailing 12-month net cash flows for Comcast's cable business, the internet business and pay TV business. As you can see, it was, a low 11 or $12 billion in net cash flow per year a handful of years ago, 5 years ago, and today it's closer to 20 billion. So the underlying results in the core business have been fairly strong. Obviously, going forward is what matters. But you've seen a major divergence between the company's stock price and the underlying profitability of its cable business, which is the most important business. NBCU is very important as well, and there's things to discuss with Peacock, but this is the real driver.
I have a question. So all the charts going from the left to right, going up, right? I mean, it looks like nothing is wrong with this business. Everything is just fine. And so is it a question? I guess I'll just rephrase. I'll ask my question differently. Do you think the business was just, had become overpriced in some sense, gotten ahead of itself in terms of the valuation during the pandemic, and now sort of has reset? Can't see anything wrong with it. Everything seems going the right way.
Yeah, I think that translating that to the business part, the question will be, is this just the hangover from the pandemic in terms of the gross ads and the net ads? How big is the contribution from mover churn? How big is the contribution from, fixed wireless competition? How much, if this is just normalization after, we've seen this with other businesses like Netflix. The normalization doesn't have to happen in a single quarter or a single year. It can take some time to shake out. So I think that's a big part of it. And I also think, more so to the stock price, I think a lot of people have questions about what the strategy is at NBCU, for example, and how that rationalization in the media industry, what role Comcast will play there. And, I think very interestingly, one, they announced the JV with Charter for basically call it the Xfinity video business in terms of now trying to be a real competitor to Roku. They're years late to the game, but they're trying to be a real competitor in a way that they weren't previously. And they did it through a JV, which I think is noteworthy. The other noteworthy development is there was speculation, or at least reports, that there were discussions between NBCU and EA about a possible deal. So I think it's becoming a bit clearer that management is not dead set on holding the hand that they currently have, and they may be open to some ideas if they come along. So the market doesn't seem to be too convinced by that, but I think it may be pretty interesting time to, I own the company, but it may be an interesting time to consider buying more.
So like with cable, Alex,
yeah.
And I know like the cash flow is still rising, but there are people cutting the wire out there, right? Like cutting the cord. Eventually, they can only raise that price so much, right? To keep getting to squeak, to keep squeezing like more water from that rock, I guess, how much juice is left there? And because eventually, I think that's like a huge overhang over the business, and why I just have my doubts about it, because I think we've all experienced like streaming is just like, that's how we watch TV now, except for like news or sports or things like that. I'm not going back to watching a 2-hour movie in a 4-hour block on TNT,
sure.
That's gone.
Sure.
So I guess where are we at here?
To be clear, that what I show there, that's the cable segment. So that includes the video business. It also includes obviously fixed telephony for anybody who still has a fixed phone in their house. and it also includes the internet business. So What's really happened here, and this is part of the evolution, at least during the time I've owned it, cord cutting was a big concern. The pay TV business decline was a big concern. And what's really happened here is these guys have effectively become indifferent to that development, because the content suppliers, the media companies, have basically taken any part of the economics that these guys had in that business by pushing so much price. So Comcast and Charter, Comcast more explicitly than Charter says this, but they're indifferent to whether or not someone wants to keep the pay TV package, at least in terms of profitability. Obviously, it has some implications in terms of bundled customer and churn and things like that. But from a financial perspective, I haven't looked at the numbers recently, but I believe the last time I looked, my estimate based on what I saw from their financial statements was that an internet customer likely generated 10 to 20x the amount of EBITDA versus a live video pay TV customer. So it's not a meaningful driver of their profitability at this point.
I don't think I recognized it, that this disparity between the two was so great.
But there is a question that I think is still relevant. What impact does it potentially have if people are becoming single single play customers with a single offering from you, does that impact churn? Does it impact your ability from a competitive perspective? And that in my opinion is part of the reason why they're so much more focused on wireless than they were previously. This is their new bundle. This is where they want to play. And, I think they start from a pretty strong position, and they don't have some of the constraints that the telcos might have, things like, very significant financial leverage and or, high dividend payout ratios. So that they start from a good spot, but this will take some really effective maneuvering and potentially, strategic in terms of inorganic, potentially a merger or, some other activity like that. So it'll be very interesting to watch.
Are they at risk of being disrupted by 5G? And I know that's not close. I'm not saying in the next couple of years, but I'm saying in the next 10 years, if 5G is so prevalent, can I just get a wireless Fire TV plug-in to my TV from Amazon and get and stream whatever I want from that wirelessly, without having to have a cable run to my home so I can run Wi-Fi.
And this is effectively what T-Mobile's doing. And I think when you dig into it, what you find is it's certainly it can be a competitive product, particularly in places where there's not a lot of competition. You don't have fiber and the cable companies going at each other's throats to try to win business. It's obviously more competitive in places that have less built out solutions. A big question is going to be, and it's why that chart about data usage is so important. If you're running wireless customers and home wireless products off the same network, and the home wireless customers are using 10x, 20x more, call it capacity or data, and you're charging them $25 or $50 a month for the home internet product, and you're charging your average wireless line $40 or $50 a month, obviously your revenue per unit is much, much, much lower for that home internet product. And, to the extent that there are capacity constraints, you either have to build out more network and justify the ROI, or you have to choose between those two customers. And I think T-Mobile, if you listen to the way that they talk about this business, it's pretty evident that they ended up with a lot of significant excess capacity as a result of the merger with Sprint. And they can effectively justify going after this business because it's a sunk cost for a lot of this, and they have no other foreseeable use for that capacity. The question will become at some point, if you do use that capacity, does it make sense to put the dollars in to build out more? And I think it's very unclear to me that the answer to that is yes, especially relative to a core wireless customer. Now, where they may be able to justify it, and I think this is where this goes over time, is bundling that with their highest tier wireless product. And then they can look at it as a relationship and think about the churn dynamics and pricing ability in that context. So I think that's probably how they find their own way to a convergence strategy that kind of looks similar to what the cable companies are doing. So I think the strategies could be similar, but I think cable starts from a somewhat better place. And the MVNO with Verizon is a major reason why.
And Anirban, any thoughts or anything else? Or
I have nothing to add, nothing to ask.
All right, excellent. All right, so the next company that we will be covering, Rebound, is Shopify. This stock, was one of the biggest market darlings, I think, during COVID, right? Pandemic. I mean, in 2020, this was at a 56 times sales, not 56 times earnings, 56 times sales. It is now down 78%. In the last year. Its market cap, which was once over $200 billion, is now under $50 billion. So this company has taken a precipitous fall. And I think what we can do is we can go back to right when the last conference call, when Harley Finkelstein, the COO, got on and he goes, "It's time for some real talk." And he goes, basically, Shopify made some large strategic bets that that the new normal from the pandemic, or the e-commerce spike we saw from the pandemic, was the new normal, and that e-commerce had taken instead of staying on that long trend line up that you see here, it had spiked up and it was permanently going to be that high and not come down to where that trend line is. Well, he basically said we got that wrong. That did not come true. and they said they're going to lay off people, like I think 10% of its workforce. And like the stock has tumbled from that. I don't think if you're at this point, if you're a Shopify shareholder, and I have a small position, that it's time to panic. It's still one of the largest U.S. retail e-commerce, collectively, its merchants like represent like it would be the second largest e-commerce platform in the world, or in the U.S. I'm sorry, like just in second to Amazon, in a distant second, but they're still ahead of everyone else. They're ahead of Walmart, they're ahead of eBay, they're ahead of everyone else out there. So it's still a dominant player in the e-commerce space. Revenue this last quarter was up 16%. Merchant solutions was up 18%. That was driven by like a solid uptake of Shopify payments, Shopify capital, and Shopify markets. Like if you follow this company, like those are like the usual suspects. I mean, this company is still doing a lot right. The problem they're having, and the problem they're going to continue to have, is like to build out like the logistics and fulfillment. They want to get to like guaranteed 2-day delivery. They think if they can get there, that will be good enough for the U.S. consumer. Like that's their bet. That if they can get to 2-day delivery, like that'll be good enough. Now, of course, Amazon, like, I mean, when I order things on Amazon now, like 80-90% of the time, I think I get it within 24 hours. Like, I don't think, like, it's very rare now for me to wait 2 days. So I don't know if that is going to hold true, or if U.S. consumers' preference are going to like rise as Amazon delivers better capabilities. And like even like Walmart, like if you order something from Walmart or Target or Home Depot, you can usually just go pick it up in the store, pretty quickly. But Shopify's betting that if they get to 2-day delivery, like a 2-day delivery guarantee everywhere, like that'll be good enough. They're doing that. They bought Deliver with a $2.1 billion acquisition in July. Deliver, it already fulfills more than 1 million orders per month. It's asset light, it's technology driven, and basically it like predicts consumer demand so that merchant inventory is like in the right fulfillment centers before customers order, right? And then it also announced a new partnership with Flexport, and that's so merchants can more like easily and cost effectively inbound freight. So like it enables merchants to like ship inventory at the pallet level versus container level, and that allows them to like be a lot more nimble and to changing buyer trends. It frees up a lot of their excess capital. And it said like early runs, like they said this in the conference call, that early runs have shown that Shopify fulfillment network merchants can expect service from origin ports up to 50% faster, like with this partnership. So they're very bullish on that. And they still have like their ecosystem is still their biggest advantage, right? Like if you want to build out an online business, and like a very large established businesses have turned to them, they have quite the ecosystem. They have more than 8,000 apps that you can use to build your business. They have more than 40,000 ecosystem partners. And that's like a huge network effect, because like, if you're a developer and you want to like develop these types of apps, where are you going? You're going to Shopify because that's where the merchants are. So I actually think that's a great network effect for them. Again, so like they were at 56 times sales in 2020, which was just like, like Anirban, when you were talking about Cloudflare, like, that valuation was just way ahead of where Shopify was. That being said, you're at 9 times sales now. You're still at like very high EBITDA ratios, the value, but I think, this is one of those things where I think they can like leverage, and once they reach that scale, like the profits will go up very quickly, I believe. So at this point, like, and like I said, I did all right by Shopify. I did trim near the top, which is kind of what I want to do with a core position. I want to get better at that, like adding when it's low and maybe taking a little off at least when it's high. The valuation was way ahead of itself, but now it's much more reasonable. I don't think this is time to panic with Shopify. That being said, the one thing I'll say is like the biggest threat I think that's facing them is buy with Prime. And buy with Prime is like if you're a third-party merchant and you can offer this payment method to to your customers. And if they choose it, so if they're Prime members, they can choose it and pay with their Prime credentials. Basically, that merchant will experience the benefits of Amazon Prime logistics. So if I'm a merchant and I'm on Shopify, right, and I have Shopify Pay set up, and so customers can select different payment options through Shopify Pay. That's great. But if I have Buy with Prime, like, I can get my product to the customer probably in less than 24 hours. Whereas if I'm going to Shopify, they're just trying to get to 2-day delivery, and they're not there yet. And they probably have a good ways to go where they can get that across the board. So, and as as Amazon has more and more same-day deliveries, and I've begun to see that. Like, I had to order like khaki socks for work the other day, and I ordered it in the morning, but as I like put on socks with holes in it, and by the time I got home from work, like, I had my new socks. It was like, it blows my mind. So as Amazon builds that out, like, I don't know, merchants might have to offer that just as a competitive offering. So Amazon could be the Shopify killer. I don't think it will be. I'll say this, I'm a shareholder of both. My position in Amazon is multitudes higher in allocation than Shopify. Shopify's a pretty small position. Amazon is one of my 2 largest positions. So they have that existential threat from Amazon, but I think from this level, I'm bullish on Shopify.
Can I have a different view on Shopify. So I actually don't think of Amazon as a competitor at all. Because I think of the market positioning in a slightly different way. So, like, Amazon is great if you want to come to a marketplace. Amazon, I look at more as a marketplace, right? So you've got all the customers, and you bring on, and you can choose your product. But if you're a brand, for example, and you want to have control on your brand, then you're better off being with Shopify. Right, because you don't have to worry about Amazon, taking your content and plagiarizing it or not plagiarizing, but coming up with an Amazon Basics product that looks like yours, a copycat of yours at a fraction of the price and things like that, right? So if you want more control, you go to Shopify. If you want, quick sales and access to a large user base, all of those beautiful things that come with that, then you go to Amazon. And then for certain things, maybe it doesn't matter whether it's like, 2 days versus, like, say if I want my toothpaste quickly, but I might be willing to wait for a designer pants longer because, that's what it is, right?
I agree with that. I agree with that.
Yeah. So I think it's a very orthogonal positioning is possible. One supports, and I think the biggest trump card Shopify's got that they don't compete with their customers, right? Whereas Amazon does, which has been Amazon's thing for everything that they do, is that they compete with their customers to some extent. So I think, to me, it looks like it's very orthogonal, like what they're servicing. And I think Shopify's move to go up market is the right move, right? To go up market in terms of the customers you serve, larger and larger. They started with the SMBs, but I think there they have, I guess, the promise of being, in control, offering you the best experience, ensuring that you don't compete with your smaller customers. But I think going upscale, where more direct to consumer, more brand control, I think that's going to become more important, especially with the tracking changes that are happening, cookies disappearing. And a lot of companies would want to have a direct to consumer relationship that is more tight. So I think there's a world in which both can actually live, and they should be fine.
Yeah. So real quick, and then Alex, I'll let you have the floor. But like, I do agree with that. Like, I think like I can wait 2 days for my designer pants, but if I need toothpaste because I'm out in the morning, I need it that night, I want it the same day. So I agree with that premise. I think, but I don't know. Like, that's a theory I have. Like, I don't know if it's right. And I do think Buy with Prime, like, yes, Amazon, I agree with your distinction between Amazon and Shopify, but I think Buy with Prime is different. And because it's offered to third-party merchants, like, I think that's like a direct, like, taking aim at Shopify 100%. Alex.
Look, I've followed Amazon pretty closely, largely in terms of on the e-commerce side, in terms of their spending for shipping costs. And it, even despite the significant ramp in revenues, obviously the shipping costs have increased from, it was 800 basis points, something like that 10 years ago. It's 1700 basis points. It's increased very significantly. So kind of to that point, has management commented on this idea of 2-day being good enough, or is the ultimate vision to try to get to parity, which obviously would suggest years and years and years of capex?
They're not going to parity, at least not now. Like their goal, which they are still, I think, not even that close to, but their goal, I think, is 2-day delivery. Actually, I like Toby, the CEO of Shopify. I think he's fantastic. I don't think he's perfect. And I think when the stock was so high, like I wish they had made they just bought Deliver with cash after their stock had fallen for $2 billion. That's something. But when their stock was so high, I wish they had gone after like XPO or, I think Scott Galloway threw out the idea like Shopify should buy FedEx or UPS. I actually think I would have loved to see that. I think that would have worked, in using their stock. Well, because it was like, when it was so richly valued, like that's the time, I feel like to use your stock for a big acquisition like that. But they're just looking to get to 2 days. I think at this point, and my thesis on Amazon is that no one can match them on logistics, and that Amazon is just like that. The moat just being, space dedicated to distribution and the money they put in. I mean, to me, that is the moat. But they're not looking to get to parity.
Yeah, go ahead.
Just a quick question. So do you know how much of that, like Prime delivery is sort of spending on last mile, like basically drivers, trucks, and things like that versus distribution space?
It's a lot. I don't know. I don't. I'm not off the top of my head.
I haven't seen a breakout. I think they show shipping expenses. The other thing that they don't do, by the way, that I should add for that comment earlier about the cost is Amazon used to more clearly show the shipping revenue side as well. And obviously, you're paying for that to some extent with Prime, and they've changed the way they kind of report at. So it's not a perfectly clean metric.
Just to add one more comment, I think like one of the things that we shouldn't discount, I think now, is in the next 5 years, the logistics of delivery could completely change, and everybody could deliver like next day, because you might have autonomous driving and you might have robots doing the delivery. So these advantages might actually disappear because the advantages might accrue to some other technology change.
But it's not just last mile, because the square feet that Amazon has dedicated to distribution dwarfs like anything, like dwarfs what Walmart has, dwarfs what Target has, dwarfs what anyone else has. And now I will say, like, as a caveat to that, it's not exactly an apples to apples comparison, because who's to say how much of a Walmart store could be dedicated to that, square feet wise, or a Target store could be dedicated to that. But it's so like I had it on my last write-up on Amazon, like the disparity between Amazon and anyone else with just the square feet, finding the real estate that Amazon has, like I would be. So it's not just last mile. It's like having these the immense amount of square feet they have dedicated to it.
Right. Yeah. So I mean, that's probably insurmountable to some extent, right? Unless you convert stores to. Yeah. But I'm not 100% convinced that is like a big deal for a different audience. Again, it matters for toothpaste and things like that, but doesn't matter for certain things. I don't know whether the head-to-head comparison is. And the other thing I think that's important in this discussion is that e-commerce is still 20% of the total possibility, and that space is still growing. So there's room for different types of e-commerce to continue growing, allowing for all these companies to actually grow. I don't know.
Yeah, no, I agree.
It's a fascinating name. It's interesting to something that I've only watched from afar, but it's been the last 2 years or however long it's been. It's funny how, many companies have done this, but the roller coaster ride you go on in terms of stock price, somewhat business results, and then obviously narrative. Yeah. It's fascinating to see, kind of, for me at least, kind of for the first time in real time as an investor.
Yeah, I agree. Same with me. It's been like Shopify's been on a crazy ride. And but at this point, if you own shares, this isn't the time to give up on it. Like when it was 60 times sales 2 years ago, maybe then is when you should have taken some off the table. But I think Shopify is well situated.
How do you think about it from here on that point? Because I think about it in names like that I own, like Spotify, very close name. How do you think about it from here in terms of kind of, the story feels like it's changed to some extent, but this happens all the time. How do you think about what you're looking for from them as you look out to the next quarter, the next year, whatever it may be?
Like my theory is what Anirban said. Like, I don't think I think just looking at myself, right? I think 2-day delivery is basically fine for a lot of items, especially discretionary items. Like 100% agree with like Anirban, which is why, I have Shopify. I think the tools they can offer merchants are second to none, with the exception of logistics, which Amazon has. So that still comes back. That's my one hole in my thesis that I'm not sure I can definitively answer. And so it's enough for me. I guess that's where it comes to like portfolio allocation, where like Shopify is a small position and Amazon is a much larger position, because I'm bullish on Shopify from here, especially. And look, and I said I trimmed at the top. I trimmed a little at the top, right? But like I still hold most of my shares, right? So I don't want to say like I chopped it significantly or down to nothing. Like I didn't get it that right. Like I took some off, which I'm glad I did. Obviously in retrospect, I wish I had taken more off, but I'm bullish on it. Like I think they're very well situated. The ecosystem they have with the third parties offering apps and tools like Wix or anyone else, like any other platform like this, really can't compare, with the exception of logistics, which Amazon has.
Yeah, I've watched this. I don't know if I just said this a moment ago, but I've watched this as someone who's followed Walmart for a long time, and I've watched them try to compete in e-commerce. And I think Doug McMillon's a great CEO, and I think the strategy they've ran has been pretty intelligent given where they started from and what assets they had. And you look at the P&L and you see just how difficult it's been to get to the position that you should on that chart, which is, 1/7 of Amazon's market share in the US or whatever. I mean, it's
right.
It's very difficult to compete with someone like that who's really running, unless, to Anirban's point, you find a way to compete with them that is not on their
right. Anirban, any last word?
Well, I'm for all the comments I made, I'm like you, Shopify is a smaller allocation versus Amazon. I mean, the other thing with Amazon is is a multitude of different things, right? I mean, it's not just a e-commerce business; it's got AWS as well, which is a pretty significant component. So, yeah. But I like Shopify at this current prices, and I agree with all those other comments. Everyone should have bought things that they wanted to buy.
Yeah.
Using
in retrospect, it's a lot
price.
easier. Like in retrospect, it's like, oh yeah, that's when you should have sold. Exactly.
Yeah.
All right, our next stock that we're going to look at for record rebound is Twilio. All right, and Twilio is down 78% from its high a year ago. Its market cap, which was once over 60 billion, approaching 70 billion, it's now down to under 15 billion. And Anirban, is Twilio a wreck or a rebound?
Yeah, I actually really like Twilio, especially the current valuation. I showed you that chart, shared the chart when we were looking at Cloudflare, right? If you just think about enterprise value to gross profits, then it's 8 times gross profit, which is relatively cheap. I think Twilio's had, this chart in this sense is that, the peak that they had during the pandemic, they had a lot of things working for them. For example, a lot of people were sending messages, which is one of the things that these guys specialize in. A lot of one-time passwords being sent, a lot of things happening digital. So they had that huge boost in their messaging business. And then of course, now what's happening is that they're lapping those really, really strong numbers. So that makes it really hard. If you go to the next chart, I think that, the next chart has it. Yeah. So if you just look at this organic revenue trend, right? I mean, if you did Q2 of 22, which is the last number on your right, that's basically comparing with Q2 of 21. They were up 50% in that quarter. That was on top of a 43% growth the prior year, right? So, the numbers are becoming bigger, and they had a much larger base on which they had to grow. So the growth rate has fallen, which is, and the market doesn't like when the growth rate falls. That's one, but I think the growth rates are falling largely because they had really tough compares. And as this graph shows, the Q3 and Q4 of 21, I think the compares become easier. That said, I think part of the problem with this company it's not been profitable, right? And if you just go to the next chart, and that probably explains this. Remove this. I should go back to the previous chart. Sorry, no, and the previous one. Yes. Okay. So if you look at this graph for a second, this is a business on what, a $3.4 billion roughly run rate. It's a $3.5 billion run rate. The gross profit on this is about roughly 50%-ish. So it's about 1.8 billion is the gross profit. Now, if you go back, if you skip the next chart to the next chart, I think this basically explains their problem. So this is a business generating 1.8 billion dollars of gross profit. It still can't print a profit on an operating basis, right? And that gets really annoying, right? If you can't do it at that scale, when are you actually going to do it? And that's what the market is basically, I think, telling them is like, look, great, you've got a big business, it's really, big, and you're still growing at say 30%. Why aren't you generating profit? Now this, one could say on an operating basis, this is pretty close. If you remove that accrual, then you're looking at a roughly break even, but I'd expect a lot more for a business that has that much gross profit that they're generating at this point. So one of the things that one needs to think about is this is sometimes an issue with founder-run businesses, is that they want to grow their empire, where the empire equals revenue, but doesn't necessarily mean profit, right? And I think the market's way of saying is, we want to see profits. So these guys have guided for exiting 2023 with an operating profit. Right, not an operating profit margin and things. So the guide is for generating a profit, and maybe if I think Jeff Lawson sees what the market is saying like, at this scale you should be profitable, then things will turn. Otherwise, this is a business at that scale growing at roughly 30% organically. That's pretty good. It's still operating in a large market. It's got this opportunity it's got roughly two segments, a software segment and a messaging business. The messaging business is the larger business, lower gross margin. It actually is growing really quickly, which is part of their problem. They have a business which has lower gross profits growing really quickly, and a smaller software business, which is also growing really quickly, but it's really small. So then, and the last thing I'll say is there's been, I would say, a bit of an inconsistency at the management level. This is another problem. You'd see that a lot of the companies that, so Meta is an example of this, that get beaten down, is that there's a lot of churn happening at the management level. There's a lot of strategy changes keep happening at the management level. And, and that is always a problem, because then you don't really know what's going on. So one of the things that they have previously said that they're happy to take the lower gross margin messaging business if because it adds gross profit dollars, which if you add gross profit dollars, that's good for the business, and then you can cycle that to somewhere else. That's one. And the second part is that, well, that's always a door. So if you're thinking of landing and expanding, the messaging business could be the land, and then you expand into software. Now, of course, that doesn't help you get quickly to the profitability equation. So now they're saying that, well, we want to switch a little bit of our focus. So they're not hiring in the messaging side, but they're hiring in the software side. So they've reduced the pace of hiring. Again, they've had a few changes at the CEO. So that George Hu, who was the CEO, he left. After he left, they had put somebody else in charge as as a chief revenue officer. That person was then, I guess, left. Then they've got they promoted the CFO to COO and hired somebody else as president of revenue. So there's this constant revolving door at the top, which is not good. So all of those things are showing. So this is, I think, fundamentally a good business that has some directionality issue that I think they can't message it, and they can't really get their heads around as to what direction they want to take. But if they can hit the profitability guidance that they have hit or suggested they're going to hit in 2023 and sort of focus on growing the software business, I think this is actually a really, really good value, right? But I'm not saying that there's a lot of conviction. My conviction has sort of reduced a bit on this business, not because of the share price, but largely because, I don't like these conflicting messages that I hear from management, and I don't like the fact that you can't generate a profit on that gross profit dollars. So if I see the profit and I see the some traction on the software side, then I'll be much happier. I still own the stock.
Sure. So you said they might get to profitability next year.
Yeah, so they're very close, right? They're already pretty close to break even. They lost $7 million in Q2. They're saying they're going to lose like $20 million in Q3. So they're pretty close. They're saying they're going to get to profitability in 2023.
Like, how quickly will that ramp? Like, are they what do they see as their long-term operating margins?
So that's a great question. So look, just like I showed that chart for Cloudflare, right? You could sort of look at the sales and the biggest chunk of any of these software companies is sales and marketing, right? But then you look at the dollar-based net expansion. That's 120% plus. So there's like 20% extra revenue generation happening from your current customer base that you have retained, right? So they could very quickly become a lot more profitable. I mean, fundamentally, they're profitable if you think about the chart I showed you and that little drawing, the scribble that I did. But and then you can see your operating margins really quickly ramp if you don't spend as much as you're spending on sales and marketing. That's number one. Number two is their long-term target. So as I said, their gross margins are significantly lower than its typical software business. A typical software business has 80% plus gross margin. This has about 55% gross margin, 54% gross margin, somewhere in the 52, 54. They want to get to 60%, right? That also adds, but what has happened in the recent quarters is that the gross margins have actually gone backwards instead of going forwards, because I think their messaging business is growing at a much faster pace because I think strategically they have been growing that side or they've made the decision in the past that they were happy to grow that side. And, they probably now realize, oh, well, that doesn't help us get to profitability because we're just, our capital investment is focused on that, whereas we should probably focus our capital investment on, or when I say capital investment, I mean dollars spent on sales and marketing and customer support and customer experience and so on. So yeah, this I think this will not be as high margin as say Cloudflare, but it should you could think of a 15% operating margin in 3 years. 15% should be doable given the scale that they have, right? This is pretty, not many businesses have that kind of scale and they still grow, 1.8 billion and growing 30%. And I'm talking gross profit, not about, just revenue. So, yeah, but.
Yeah, it's interesting to see. I mean, it's similar to Cloudflare in some ways in the way you discussed it, and going back to Amazon, something they experienced a lot in the early 2000 or early mid 2000s. It's just interesting to watch these companies where, and especially when you start talking about a lot of stock-based comp, how narratives and earning the trust of your shareholders is just becomes so important. And it's so different than, at least for me, when I started out in investing, you're just, hey, be long-term and short-term stuff doesn't really matter. And then you see how for the people operating these businesses, it's not really that simple. And you have to think about these things and they actually do matter. And I just find it fascinating to watch these things. And I'll be curious to see what their kind of trajectory looks like here over the next year or two.
Yeah, so Alex, you hit the right, so SBC is a problem for all of these businesses. And as the stock price goes down, the SBC becomes a headwind. So that's something to definitely keep an eye on. And, ultimately you want to be free cash flow positive, right? And you want to use that to grow your business and have, my threshold is like, you don't want to have more than 1% dilution in a growth business on a fully diluted basis, right? If you're diluting by 5% every year, that business is not going to generate, it's very difficult for that business to generate market beating returns for you, because then now you have to generate like in excess of that, right? So 1% maybe is okay, 1% or under, but yeah. So something.
Is there a larger tech company that you think of as someone who would be potentially interested in buying Twilio, or is it kind of unique and doesn't really fit in anywhere very well?
Well, so the one company, so I think this company is interesting to backtrack for a number of reasons. I think this direct to consumer is a real trend. I think there's this shift happening. So where you needed to be in a platform and advertise and track. And if you switch that, it's very expensive to actually reacquire the same customer. So if you want to switch back and actually control the customers that you've got and then sell to them again and again, that's a really interesting proposition. So that's, basically, having customer data platform. So in that sense, the most appropriate company where they would fit is Salesforce, which is very acquisitive. Right, and this company's origin is Salesforce. So, in fact, Salesforce Venture, I believe, was one. And these guys, the founders worked at Salesforce. So, the Salesforce is the mothership to say. But
I feel like every founder has worked at Salesforce. Like, I
call it the Silicon Valley tree. There is Apple, Steve Jobs at Apple, then there is Benioff, and then there's all these things that have spawned from the Benioff tree. But I think there's an issue, though. I think the appetite for mergers and acquisitions is going down, I would say, as the cost of capital goes up, right? And Salesforce has just made, I think the largest one that they did was Slack, which I'm sure they're repenting. They should have just waited for the pandemic for Slack's share price to have been cut by God knows how much, and they could have paid peanuts to buy it, right? So I think that's, but I would say that's the likely suitor. Maybe Microsoft. The other company that has shown a lot of appetite for acquisitions is Microsoft. So maybe Microsoft, it fits in there. Maybe even Google. They've got a lot of free cash that they don't know what to do with, and they have an appetite for big acquisitions.
All right, gents. Yeah. To keep this from being any more of a marathon, let's just move on. One more company, and that will be Disney. Disney now, from 3 years ago, before the pandemic, it is still down 40%, and that was after a huge dip during COVID, then a fast rise back up. When Disney Plus took the headline, but now it's still back down to negative 39%. The market cap for Disney is now $223 billion. At its height, it was $325 billion or so. Alex, is Disney a wreck or a rebound?
Let's just jump to the first slide so I can frame the conversation appropriately. So this shows the direct-to-consumer run rate revenues for Disney in relation to the content cost for the direct-to-consumer businesses. And as you can see, basically the run rate gap now is about $5 billion. The gap's kind of been in that range for over a year now, but Disney's still in the somewhat early stages of ramping its content spend and, supporting its D2C businesses. And a big part of driving D2C revenues is subscriber growth, which has been the primary lever that Disney has pulled so far. What we're seeing now is that the company is going to start driving pricing a lot more aggressively. So, they're following, in my opinion, something that looks similar to the Netflix playbook, obviously on a much more condensed time frame. But I think they're showing you how this can become a large and potentially very profitable business over time. Next chart. Yeah, this is a breakdown of the paid subscribers by market. Basically, the Disney Plus Hotstar is prominent service in countries like India, decent number of subscribers, but very low ARPUs, typically under $1. The core Disney Plus product, obviously, it's a larger subscriber base, but more importantly, a much higher ARPU. So, it just breaks down between the two because they basically should be viewed as different business opportunities, at least in the short term. Next slide. Yeah, these are the ARPUs by month for Hulu and ESPN Plus are US properties basically, and that's the Disney Plus global ARPU. So as you can see, the ARPUs are still pretty low, especially for Disney Plus, and ESPN Plus is still finding its footing as well in terms of its role in the business. And you're going to see significant changes on the standalone ARPUs for these offerings. I think Disney's strategy is pretty clearly, at least in a market like the US, to drive as many people as possible to its bundle and to try to replicate a lot of its strengths across these different content genres to build something that at the end of the day looks somewhat similar to what their strategy was in pay TV, but granted it can be global in a way that they weren't previously, or at least not to the extent that they can be now. Next slide. Yeah, this is just a breakdown of the, kind of the overall subscriber bases. It's pretty fascinating that in Disney Plus launched in November 2019, and in less than 3 years, they're at 152 million paid subs, granted at a much lower blended ARPU than what Netflix is at, but Netflix globally is at 220 million after 15 years. So Disney's had a lot of success in this space, at least early on the subscriber front. In my mind, they're very clearly the entrant that's had the most success so far, but now they need to figure out the other part of the playbook, which is really driving ARPUs and driving revenues. And Netflix has played that game very well, and be very important for Disney as they move forward to do that as well. I don't know if we have another slide or not. Yeah, this just shows the overall industry, and it kind of brings that last point home. This is looking at the D2C businesses for a few of the major players. You can see that Netflix run rate D2C revenues globally are north of $30 billion, with about half of that from international. Disney's closer to 15 billion when you back out Hulu Live, which is their vMVPD. It's just like a live TV product, basically. So it's not really comparable in terms of D2C. So this has that backed out. They're at about 15 billion. Warner Brothers Discovery is at about 10 billion, and Paramount's at about 5 billion. So in terms of scale being a relevant metric in this business, which I think it likely will be, it's an important, and on a global basis as well. Netflix has a very clear lead, and Disney's covered a lot of ground in the last 2 years, but there's a lot of work left to be done. So I think it's still a very messy story overall. It's very helpful that linear is still contributing significant profitability to the company. It's also very helpful that parks have rebounded in a major way, and some of the kind of strategic tweaks that they've made to the business have really showed up in terms of kind of the financial results. So it's a company that, as the world can, I should probably show up the other chart I have with the Nielsen data for viewership. Streaming was 35% of overall TV time last month in the United States, and it's jumped about 10 percentage points in the past year or so. This market's moving to streaming, and part of the question is, as we make that transition, how do you play the hand you have, and how do you invest for the future? And in my mind, Disney with ESPN and its other assets is very well positioned to make that change. And I probably should note on that point, Dan Loeb at Third Point has been, well, he bought the stock previously, then he sold it. Now he's back in again, and he's kind of pushing for changes. And one of his proposed changes is spinning off ESPN. And I think it would be a massive strategic change. It would be a massive financial change for the company to do it. I think it's something, in my mind, I think it might actually be the exact wrong decision, particularly as Disney overall is navigating this next, call it 5-10 year period of structural decline in pay TV, and finding their path forward in the new world. But we'll see whether or not management is willing to let his voice have any impact on their decision making.
So I'm a shareholder, and yeah, I basically agree with everything you said. I don't disagree with much. Do you think the new CEO though, Chapek, do you think he is I guess my biggest question now is about him. I think the company misses Iger, and I think he almost he stayed so long that he drove off other maybe more competent leaders. And in the meantime, now we have Chapek, and I don't know how deep Disney's bench is for someone to come in and take over all of it. And I guess that's my biggest concern. How important is the leader? During this transition, I kind of think it's more important than normal. I don't think Disney's IP isn't going anywhere, things like that. So normally during quote unquote normal times, I don't think the CEO is as important, but during this huge transition time, I think it is more important. And I'm wondering if they just have the wrong guy at the wrong time.
Yeah, I think on the first point, for all the accolades Iger deserves, particularly for the acquisitions that the company did, which are hugely, hugely important to where they sit today in terms of their streaming assets. Those accolades should be couched in terms of what he did to the C-suite, and how delaying his resignation multiple times was very disruptive for the company. And after he left, having
for sure. Yep.
Having his comments be shared publicly was also disruptive to the company, and
don't do that.
Not for the best of the Walt Disney Corporation. Chapek, I think, was dealt a very tough hand in a lot of ways and navigated through, obviously the pandemic was very disruptive to the parks business, and the parks business is back in a very good place. And, D2C has also done very well, and that's not directly attributable to him necessarily, but, I think the most important thing for him to do from my perspective is to ensure that people like Kevin Feige at Marvel and, the content creation engines are positioned to make the investments that they need to make and, have the proper time horizons and just be thinking about the long-term health of the business. If he does that well, I think the company is in a position that even if he isn't the greatest CEO of all time, he can make the asset base work.
Anirban, any thoughts?
No, you stole the question I was going to ask. So yeah, basically big shoes to fill is the issue.
Yeah.
I guess one of the things that I think this is a Disney advantage versus not, like Netflix basically has a single, basically has to spend on content that gets distributed on Netflix, right? And they have to produce a lot of content to basically keep people glued to the seat. One of the IP advantages, aside from the IP advantage that Disney has, Disney produces content for the theater, and then it can monetize it through the theme park, through the theater, through streaming. Then it can monetize it through different kind of make Lion King 10 times and make a Lion King for the TV. So I think that's so they're multiple bang for their buck. I think which puts them in a really sweet spot, right? I don't know. I think
yeah. I wrote it one time as what Disney's ability to replicate Netflix is easier than Netflix's ability to replicate Disney, and I think a lot of that's still true today. That said, you do have the risk of, as people have often discussed, Marvel fatigue, superhero fatigue. Star Wars has been good in some. I'm not a massive fan, but has been good in some ways, and there's been a lot of complaints in other ways, and especially as you start thinking about, the Nielsen chart showed up earlier, Disney Plus's viewership share in the US is pretty low, and that partly speaks to the nature of their content. But I think they also try to plug that hole by having multiple series and multiple movies from these franchises. And the thing that always has to be kept in mind is ensuring that you're not hurting those franchises by increasing the output of those content creation engines. So it's a difficult balance, but yeah, there's definitely fantastic assets to have, and it speaks to how they've had so much success so quickly.
Yeah, there's something to that. Like I was actually just talking to my son the other day. My household pretty much Marvel fans, Star Wars fans, all the way through. But I was talking to my son, my oldest son, and we were like, since Endgame, Avengers Endgame, like 4 years ago now, like we were saying, like what Avenger movies or Marvel movies were really like must see, are really great. And it used to be like, they went on a run where it was like every, it seemed like 7 or 8 in a row that were just amazing, right? Like, and through Endgame, and then it was like, oh, the Spider-Man movies were really good, yeah, but those aren't owned by Disney, and the others like are just okay, and not great. We still go see them, we still watch them all, but like you can feel your love for the franchise is kind of dying down. And the other thing too is, and like, if we can go back in time a little bit to go through this transition now with their balance sheet weakened from that huge Fox acquisition a few years ago, like I think I guess, like Alex, in your opinion, like how was that acquisition necessary, given like the state of their balance sheet since then, or do you think like it was a necessary move?
There's 2 important things on the Fox deal, I think, that always have to be kept in mind. One is, some of the monetization that took place as the deal was basically closing or right after it closed in terms of the RSNs and then the stake in Sky. The other important point is Star and the assets they now have in India, and that was directly attributable to Fox. And then the third one is, which I think this is important in light of the Disney Nielsen data I was talking about a moment ago, they now have majority control of Hulu. They're eventually going to own all of Hulu once this arrangement with Comcast finally comes to an end. It gave them content creation engines like FX, which is and Nat Geo, which is, different than, especially FX is different than kind of their core audience that they serve. So if you're thinking about this in terms of these eventually being consolidated or at a minimum bundled as they are now and serving everybody in the household, they pretty clearly had a blank spot in terms of doing that I think FX goes a long way towards helping. To the first point you were making, I often think back to, Berkshire owned Disney as a result of the Cap Cities deal in the late 90s. And like Anirban said a moment ago about remaking these movies like Lion King and everything, I think Disney went through a very difficult period where their content creation engines didn't have the oomph that they did previously. And I've often wondered whether or not that was kind of a key reason that Buffett ultimately decided to sell the stock. And again, Iger came in and did Pixar and Marvel and Lucasfilm. But, think about what this company has outside of those assets. And it just speaks to, it's very difficult to keep that going. And it has to be such a core focus of the company. And when super fans are saying things like you are, that is very concerning. So it's something to continue to keep an eye on. I mean, the box office data up until recently, or even up till now, has continued to be very, very, very strong. But that brand equity is paramount.
Sure. And Anirban, any thoughts?
No, I have nothing to add.
All right. So if you've been watching on YouTube, or if you've been listening, if you watch on YouTube, you'll see that we went through a lot of these companies with our help of our friends at Ycharts. And there's also some like beautiful charts that were thrown in for some of these companies. Alex, is there a newsletter where maybe we could see more of those kinds of charts?
Yeah, if you check out the TSOH Investment Research Service, Science of Hitting Investment Research Service, you can see all my charts there. And obviously I include write-ups with those as well. And you can also follow me on Twitter if you want to see just random charts that have no explanation.
I can attest it's an excellent service. I subscribe. I'm very happy. I read everything that you put out. It's a great newsletter.
Thank you.
I think that wraps it up. Gentlemen, thank you so much for joining me. I'm Matthew Cochrane. We're 7 Investing, and we're here to help to empower you to invest in your future. Have a great day.